Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hi, everyone, and welcome to the Top 5 at 5 once again. I love doing this because I think that there's so much interest in listening to veterans on Wall Street and Bay Street in terms of how they're thinking about the markets, and also importantly, providing you with some of their top picks. That's the Top 5 at 5. That's the whole point. Today we have Darren Sissons. He's a partner at Campbell Lee and Ross Investment Management. Darren, great to be with you today. Thanks again for your time. And good to always have these discussions. So thank you.
Yeah, thanks for having me.
Darren, I want to first get your kind of quick top-down view, even though this is so stock focused, the point of this conversation. But given all the volatility and uncertainty surrounding inflation and the Ukraine-Russia war, what is your top-down view these days?
Yeah, so, the war itself, I think there are two narratives in the market. The one predominant narrative in Europe tends to be the Ukraine conflict, and I think that's a separate animal. And then we have obviously the interest rate story, which is really a regime change. And I think one narrative will ultimately come to dominate, and we'll see that. But for now, let's run with the narrative that's the interest rates, because we're in North America, and that's the sort of the story here. So I do think we're having a regime change where previously it was very loose liquidity conditions. Obviously, excess liquidity caused bubbles in housing. Caused bubbles in a lot of the equity sectors, particularly very high growth sectors. Kathy Woods obviously saw a lot of run up in her names. But as that dynamic has changed with interest rates, and especially, like, for example, Canada raised interest rates 50 basis points last night. The Kiwis did the same thing, but 12 hours earlier because they're a day ahead. And then we've also seen we have expectations the US is going to do 50 basis points. So really, we're moving towards a situation where money is going to start costing, reasonable levels, and the expectation it's going to cost even more moving forward. So that's going to change in many ways what's happening in the market. It's going to cause a rotation into different segments, and it also creates a very large scope for policy errors. If, for example, the Federal Reserves and the other central banks push too far and then are required to correct. And I think the issue is going to be is really the overall level of debt in the system, be it government, be it corporate, and be it personal. If interest rates are raised too quickly, it will cause a situation where bankers will be given the keys to various houses, properties, and corporations. So the central banks are really in a difficult situation, but they do have to start managing inflation, and that's really the underlying issue.
Do you fear, or are you positioning for a recession?
I do think we're going to have some form of slowdown. I think that obviously Europe's slowing down because of the conflict. You've got China largely, to some degree offline because of the zero COVID policy. And then you've got high energy prices. That's somewhat of a toxic brew. So I do think we're going to see slower growth. Whether it falls into a technical recession, which is what two consecutive quarters back to back, that will in many cases depend on the individual countries. But I definitely wouldn't rule one out, but I don't think the base case is 2022. I think it's more 2023, later 2023, and definitely if central banks get the calibration of interest rate movements wrong. If they do, we could go into a recession, obviously a lot quicker.
Okay. With that said, what are your top picks these days? And I know you have a real focus on energy. Why don't we start there?
Actually, I wouldn't say we have a huge focus on energy. We do have energy in the program, and I think that the energy trade is largely tied, rightly or wrongly, to the Ukraine conflict. Russia is obviously a big supplier, and there's real question marks around their continuing supply. So really, with that in mind, with three names that we would suggest, I think, and they've had quite good runs, would be Equinor, obviously out of the Nordic region. We've owned that for a long period of time. So obviously the national champion as well, the former Statoil, Shell, and Suncor here in Canada, for different reasons. I think Equinor is going to benefit from really the concerns around Russian oil and gas going offline. And obviously that's created higher energy prices. Shell, I think, is somewhat of a composite story. It's obviously been the forefront of ESG movements, so it's paid down debt, it's moved into the renewable space, and it's spending a significant amount of capital moving into the renewables area. And obviously with a good balance sheet, much better than it was going into COVID. And obviously the scope for buybacks and dividend increases. So that's an interesting story. And then really locally here for Canadians, Suncor, it's just a smaller scale Shell. They've got some renewable projects going on. They've obviously got a big oil base out in the Western Canada. So I think that's kind of how we're thinking about it. But I would suggest people perhaps start thinking about de-risking. If you've made good money, significant gains on your energy, you might want to take some profits here. You don't want to ride these trades up and down, because if there is a definitely a conclusion in Ukraine, then oil is going to fall and the energy names will fall. So just beware on the energy exposure.
With respect to energy, I mean, the long-term bullish secular argument, which doesn't sound like you are in that camp, is the fact that we are and will be in a bullish secular move for energy, because there hasn't been the development for the past 10 years. That, the CapEx and the money that used to flow into the energy sector hasn't been there for 10 years. We don't have the supply. You can't just turn it on quickly. And there really is a supply crunch. And, post China shutting down because of COVID, just even think about what the demand for oil will be when that happens.
I would not discount anything you've said, and in fact, I think that is really the underlying premise of why you buy oil. I think I think you've got 2 points here. Number one is which you've just stated, the very rational point of view, which is there is a supply constraint. Very much ESG are pushing mandates such as they sued Royal Dutch Shell, and then subsequently decided to stop the lawsuit after Royal Dutch Shell wanted to counter. You've got the Greta Thunberg effect. How dare you? All of that routine has led to banks, for example, getting pressure of lending into, for example, the Canadian oil patch and so forth. That is going to be a structural headwind, and I do think there is going to be some rethinking around that issue. There's also the issue in Europe, for example, which has much more dense populations and more of a dense landmass. The electrification of the grid is obviously an opportunity, but that still there's still not enough grid investment. There's still not enough generation capacity to offset the carbon loss. So definitely the underlying thematic is, but our view, rightly or wrongly, is that the transition to electrons for transportation is going to take a lot longer, and it will be a number of solutions. It will be hydrogen. So we have obviously exposure in the hydrogen space. That's a different discussion, but so I do think it's going to be a composite mix, but I do think at these levels, the amount of cash flow that's coming off the debt structures, which are very attractive, and the opportunity for buybacks and total shareholder returns makes some sense for energy moving forward. And I do think the transition away from carbon is going to take a lot longer than a lot of the environmentalists are expecting. And perhaps the other unintended consequence is that if you start investing and pushing capital into the electron space, the Teslas and so forth, where's that generation going to come from, and at what cost? And that is really the unintended consequences that's not being fully fleshed out.
With respect to one of your names, Equinor, I'm not familiar with that company. I mean, in terms of really having watched it for years, can you give us a little bit more granularity? And is it an ADR?
Yeah, so it was the former Statoil, which is the Norwegian. It's basically, to all intents and purposes, those who follow the markets will know that Norway has effectively the largest sovereign fund in the world. That company formed the premise of where all that capital came from, and over time, obviously the Norwegian government has sold down, and the company was previously named Statoil. They changed the name 4 or 5 years ago to Equinor. The Canadian, the ADR ticker is EQNR. And it tends to be quite a good leverage play on oil, and it's actually had quite a big move. in relative terms, Shell has not moved so much. I would say Equinor is a definitely a super major, but obviously Shell is a behemoth. So it's an order of magnitude larger, but still, both companies would be substantially bigger than Suncor, for example.
Right. Okay. Good to hear about it. Let's take a look at another name that you're bringing us today, and it's within the healthcare space, J&J, Johnson & Johnson.
Yeah. So I do think with the transition to higher interest rates, the cost of capital is going to increase. And then ultimately, one of the dynamics that we heard in the markets many times was Tina, there is nothing else. So as we start to see high costs of capital, there is going to be an opportunity to start thinking about defensive opportunities and sort of defensive segments. And if you look at a lot of healthcare, there's been a very strong inflection in the last few months on healthcare. So I think that is going to be a theme that's going to carry forward, particularly if interest rates continue to rise. Moving into sort of J&J itself, J&J, like a number of the big pharmas, is spinning off their consumer business. And what they're going to do is they're then going to start focusing more directly on the pharma in the medical devices business. So there's an opportunity for a one-time special dividend, or for example, similar to what the AT&T Warner Brothers spin out, you might get some shares. There'll be some combination that will be fleshed out, but you'll get a stub position of something, or you'll get a special dividend from the consumer business, and you'll get the residual will be a faster growing piece focused on obviously higher growth through the pharmaceutical and the medical devices. So I do like sort of these catalyst stories, and I think that this is one that's going to be quite interesting moving forward.
What was the company's rationale for spinning out the consumer business? One of the reasons why I've kind of always liked J&J in many ways is because I actually liked the medical side of the business with the consumer side, because it kind of acts as a bit of a balance for difficult times in the market.
And that's a great story. And if you look at the sort of the dividend aristocrat element of J&J, that was obviously some of the underlying premise: stability of earnings, growth earnings. You had a portfolio diversification, and if one engine wasn't firing, it would obviously move forward. But what effectively has happened is management see more opportunity in the pharma side of the business. And obviously they're relatively recently, they made a large acquisition, and it moved the needle of the underlying level of pharma exposure north. And I was always of the view that there was either going to be another medical device acquisition, or there was going to be another consumer acquisition. But in the current environment, in markets go through cycles where non-core assets get shared, management's focus in different areas. In this particular environment, the thematic across a lot of big pharma is to shed non-core businesses. For example, Sandoz, Novartis is looking to sell off the Sandoz generic business. You've got Sanofi's looking to shed some assets, Roche across, and they're looking to sort of perhaps think about the portfolio that they own in an EVA analysis type point of view. What's the cost of capital underlying and owning those businesses? What's the economic return? And can I get higher returns by pushing capital into other areas and selling off assets that don't work? So classic portfolio management is really one of the underlying themes that I would think is really occurring, not just at J&J, but across the industry.
Interesting. Okay. Let's take a look at your next top pick. It's in the utility space.
Yeah, so it's Algonquin Power. This is a Canadian-centric name, but I do think the broader renewable space is interesting. And I really, the catalyst here, again, will be growing dividends and growing earnings, but it's really tied to a cost of capital concept. So many of the regulated assets in the renewable space particularly have earnings tied to the cost of capital. And so when the cost of capital rises, that will then enable a positive confirmation from the rate cases when they ask for higher returns. For example, our cost of business is going up by 5%. We need to get a 5% return. So I think that's going to be one element. So that will raise returns. But perhaps even more importantly, at a higher cost of capital, there will be some projects that were previously uneconomic will then be economic and could then be economic to pursue, and obviously to grow the universe of addressable products. So you've got an opportunity to re-rate the profitability from underlying assets, and you've also got the opportunity for a larger universe of opportunities, a greater skill set. a greater opportunity set. So I think those are the types of things that we're thinking about in terms of renewables. But I would say that concept of higher cost of capital will trigger across many of the regulated utilities. And so that's not just a Canadian-centric story.
So what does that mean then?
So for example, let's say, for example, when you break down the cost of capital, you'd have a debt cost, you'd have an equity cost. And it's effectively the inverse relationship to what's happening to tech. For example, as interest rates rise, you have to have a higher return to justify an existing multiple. If you've got a lower multiple and the cost rises, then you're going to get higher earnings. So they should talk to, higher opportunity, and just in terms of multiples, but also it should lead to higher revenue growth. Because if you have a regulated asset and when management go to ask for a higher return on the assets, they will go to the regulators and say, okay, well, historically we were earning 3% on this asset. Our cost of capital was 2%, for example. So the net spread was 1. If the cost of capital rises to 4%, then they should be allowed to maintain their profit delta, and they'll argue for more. And so, if interest rates move up significantly, that will increase those costs.
Got it. And how has the stock performed? I had a technical analyst on a couple of weeks ago, and he was really highlighting the utilities to us. How has Algonquin performed?
So, I think the answer is depends on how long you've held it. So, what happened was, and I think the inverse of what I'm telling you happened last year when there was an expectation that interest rates were going to rise, and they did it. And perhaps the best example is look at a company like Ørsted, which is the global leader in offshore wind. Their chart went meaningfully down. And I think the argument now would be that in a rising interest rate environment where people are going to be looking for income as opposed to a growth return, where will they go to? They'll go to companies that have the ability to grow their earnings streams. But in full disclosure, utilities are not major growth engines. They are stability, and they also tend to be somewhat growth. So if you can combine underlying growth thematic with a growing dividend, that's probably an attractive opportunity for certain types of investors.
Absolutely. All right, Darren, we will leave it there. Thank you so much for your time and your ideas today. We've got energy, we've got Algonquin Power, and J&J. Thank you.
Thank you. Have a great day. Stay safe.
You too. Thanks. Bye.
Bye.